So, you've decided to start investing. That's fantastic, seriously. It's one of the single best decisions you can make for your financial future. But here's the thing, the path to successful investing is littered with traps. People get excited, hear about a hot stock, see something blowing up on social, and jump in head first. It's not a casino, it's a calculated strategy for building long-term wealth. Today we're counting down the 5 mistakes new investors always make, and how to avoid them. Alright, let's get right into it. Mistake number 5, investing without a plan. You'd be shocked how many people throw money into the market with no strategy. They treat it like buying a lottery ticket. They hear about a name, buy a few shares, and hope it goes up. This is not investing, it's gambling. Without a plan, you have no direction, no benchmark for success, no rules when things get volatile. Your plan is your North Star. A real plan starts with defining goals. Down payment in 5 years, retirement in 30 years, passive income. Different goals need different strategies, timelines, and risk levels. Assess your risk tolerance honestly. If your portfolio drops 20% in a month, do you panic and sell? Or see a buying opportunity? Risk tolerance dictates asset allocation, stocks, bonds, real estate. Young high-risk investor and maybe 90% stocks. Nearing retirement, closer to 50-50 with bonds. Detail what you'll consider. Index funds or individual stocks. If stocks, set criteria. Profitable companies with strong balance sheets. Focus on sectors you understand. Technology, healthcare. Write it down. Include rules for buying and selling. Automate a set amount monthly. Dollar cost averaging. Have sell rules. Price targets. Or exit when fundamentals change. Profitability deteriorates or market share erodes. Think of it like building a house. You need a blueprint. Objectives, timeline, risk tolerance, buy, hold, sell strategy. Before you invest $1, write this down. A single page with goals, risk tolerance, basic strategy. Starting without one is like sailing without a map. You might get lucky, but more likely you'll be lost at sea. Moving on to mistake number 4, following the crowd, also known as herd mentality. In investing, this appears as FOMO. By the time a stock is the talk of the town, smart money has often already left. Big gains are likely gone. You're buying near the peak. The crowd is a lagging indicator. They get euphoric at the top and panic sell at the bottom. The opposite of buy low, sell high. Think .com bubble. .com name soared, then fortunes were wiped out overnight. Same pattern in the housing crisis and various cryptocurrency bubbles. The crowd chases hype, not value. Hype is a dangerous foundation. Antidote: do your own research. Trending on social media doesn't make it a good investment. Look past the hype. What does the company do? Is it profitable? What's its revenue growth, balance sheet, competition, and moat? Public companies file 10Ks and 10Qs. Find them on SEC Edgar. Read the business summary and key financials. Independent thought is a muscle. The more you use it, the stronger it gets. Be willing to be contrarian. Be fearful when others are greedy, and cautious when euphoria takes over. When the crowd panics and sells good companies. Disciplined investors find buying opportunities. Mistake 4. Blindly following the crowd. Viral tips, hype, poor decisions. Solution: cultivate independence, do research, focus on fundamentals and long-term growth. Learn to ignore the noise. Mistake number 3 can derail your progress. Ignoring risk management. Many focus on upside and forget the downside. They put all their eggs in one basket or take on too much leverage and get wiped out when markets turn. First rule: preservation of capital. You can't make returns on money you've lost. The most fundamental risk concept is diversification. Don't put your entire life savings in a single stock. Unsystematic risk, a new competitor, a failed product, a lawsuit. One blow can decimate a concentrated portfolio. Spread across assets that don't all move together. Many stocks, different industries and sectors. If tech struggles, healthcare might shine. Diversification smooths portfolio returns. Go beyond stocks. Include bonds, real estate, commodities like gold. Stocks down, bonds often buffer. A simple 60-40 portfolio has been a staple for decades. For beginners, low-cost index funds or ETFs deliver instant diversification. Position sizing matters. If one stock is 50% of your portfolio, you're not diversified. Rule of thumb: don't let a single stock exceed 5% of total value. Consider stop-loss orders to enforce discipline. For example, buy at 100, stop at 90 to cap a 10% loss. It removes emotion from cutting losses. Stress test. What if markets drop 30%? What if rates double? How do bonds react? Expose weaknesses before they hurt you. Make risk management core to your plan. Diversify across assets, size positions sensibly, and protect your downside. Mistake number 2 is as tempting as it is destructive, trying to get rich quick. These stories are like financial lottery tickets, highly visible, alluring, and statistically rare. This mindset pushes absurd risk, bypassing solid companies for speculative story-driven bets. All in on penny stocks, heavy leverage, or options you don't understand, chasing a life-changing score. More often than not, it leads to ruin. Chasing fast returns is the fastest way to lose your money. Sustainable investing is frankly boring, not home runs but consistently getting on base. Wealth comes from the relentless power of compounding. Invest $10,000 and earn 10%, that's $11,000. Next year 10% on $11,000 becomes $12,100. Over decades it's explosive. That initial $10,000 can exceed $174,000 with time and steady returns. Compounding's 2 ingredients are time and a reasonable return. Trying to skip time by maximizing return is a fool's errand. Chasing 1,000% gains often ends in negative 100. Aim for steady, repeatable returns. Buy broad market index funds, and ride the economy's long-term upward path. Or own high-quality dividend-paying companies with long histories of profitability. Embrace patience. Let investments work over years and decades. Resist tinkering and constant trading. Trust the process and let compounding do the heavy lifting. Let time be your greatest ally. Smart investing is a marathon, not a sprint. And here we are, at the number 1 mistake, letting emotions control decisions. This is the single biggest destroyer of wealth in the market. All the knowledge is useless if you can't control fear and greed. Greed fuels following the crowd and the get-rich-quick urge. See a stock double? Greed says toss the rules and pile in. It tempts you to buy at bubble peaks. Fear kicks in when portfolios drop. Every fiber screams to sell at the bottom, locking in losses. The cycle runs from capitulation and despair up to hope, relief, optimism, excitement, thrill, euphoria, the point of maximum risk, then reverses to anxiety, denial, fear, desperation, panic, capitulation. Emotional investors buy at euphoria and sell at panic. Create systems and rules that take emotion out. Your written plan is your greatest defense. Keep an investment journal. Why you buy, why you sell, your thesis, key metrics, price target, exit triggers. Review what worked, what didn't, and whether your reasoning was sound. Automate monthly investments into index funds. Dollar cost averaging removes timing emotion. Be detached and businesslike. You're a part owner making decisions on facts, data, and predetermined strategy. Master your emotions and you'll have a monumental edge. Recognize fear and greed as enemies, and build defenses. Plan, journal, automation. Master your mind, and you will master the market. So there you have it, the 5 most common and costly mistakes that new investors make. A solid plan, thinking independently, and managing risk keep you from get-rich-quick traps. All of it is armor against fear and greed. Avoid these 5 traps and you set up a lifetime of successful investing. Smart investing isn't about luck, it's about discipline. Start investing wisely today.